Thank you for joining today's Evolving Role of the Auditor webinar. The webinar browser allows you to customize your experience through actions like maximizing your slide window or even going full screen. On the upper right of the screen is the Q&A tool. You can enter a question at any time and click Submit. We encourage you to explore the icons on the dock at the bottom of the console. Here you can access technical support and more. Now, please welcome your host for today's webcast, Tom Davenport.
Hi, hello and welcome to today's Deloitte Fireside Chat about the evolving role of the auditor. It's broadcast live at www.sechistorical.org. I'm Tom Davenport, a professor of information technology and management at Babson College, co-founder of the International Institute for Analytics, a fellow at the MIT Center for Digital Business, and a senior advisor to Deloitte Analytics, and I'll be the moderator for today's program. Joining me today are Dan Sunderland, who is the chief auditor of Deloitte & Touche LLP, and Will Bible, who is an audit partner and someone quite focused on audit innovation, also at Deloitte & Touche LLP. This is a series, not just a single webcast. The Deloitte Fireside Chat series is made possible through a partnership between Deloitte & Touche LLP and the SEC Historical Society. Deloitte is, of course, the brand under which tens of thousands of dedicated professionals and independent firms throughout the world collaborate to provide audit and assurance, consulting, risk and financial advisory, risk management, tax, and related services to select clients. The SEC Historical Society, through its virtual museum and archive at www.sechistorical.org, is the preeminent source for original and primary material on the regulation of the capital markets. Today's broadcast is the 13th, I hope it won't be unlucky, in the series that began in 2009 to address current issues in financial regulation of interest to the accounting and auditing professions. These Fireside Chats are now the longest continuous running program series in the museum, and all of the past broadcasts, ranging from disclosure effectiveness to the role of professional judgment, even an earlier one on changes in the role of the auditor, are available in the Deloitte Fireside Chat section of the virtual museum under the Programs tab. There have been more than 65,000 visitors to the virtual museum and archive who have accessed one or more of these chats since the broadcast, and I encourage those of you who are joining us today to check out some of the previous chats at the conclusion of the broadcast, and I think you'll find things that are certainly worth your time and interesting to you. Today, of course, we will be exploring the evolving role of the auditor. The role of the auditor has changed a great deal since the SEC was established in 1934, but the events of the past 15 years have greatly expanded and diversified that role. If you note on the Historical Society website, this is the 15th anniversary of the Sarbanes-Oxley regulation. Of course, that change isn't stopping, and we're going to talk about that some today. If you have comments or questions, feel free to use that tab on the webcast to put in yours, and if we have time, we will get to them. And now I'd like to turn things over to Dan Sunderland, who is the Chief Auditor of Deloitte & Touche LLP, who will talk to us about changes in the internal controls role of auditors. Dan?
Thanks, Tom, so much, and good afternoon to everybody. I don't like the 13 number floating around out there, but I think we'll be fine today. So I was going to touch briefly on internal control, and in thinking about this topic, when financial crises have arisen and when confidence in corporations wane, comfort has often been sought by waving the flag of internal control. So you think about the times when quote-unquote internal control came to the fore. Think back to Watergate and think about all the legislation that eventually came out of that Watergate era, including the Foreign Corrupt Practices Act, which was focused on foreign bribery by U.S. corporations. It was identified as a problem that needed a solution. Part of the solution was to include within the FCPA certain accounting provisions that required corporations to devise and maintain an adequate system of internal accounting controls. Now, but what internal accounting controls meant was really left for the courts to decide. It was merely a principle that was set forth back at that point in time. Move on to the mid to late 80s and the savings and loans crisis. And think about the Treadway Commission that was established in around 1987. The Treadway Commission, if you recall, was intended to provide recommendations to help reduce the incidence of fraudulent financial reporting. What grew out of Treadway was the Coso internal control framework, and that came out in about 1992. What happened was then we had a comprehensive framework for internal control, but it was almost a solution that was looking for a problem. It was what I would characterize as a normative framework. It was what should be. But again, none of this was mainstream. Internal control would come up in litigation and special investigations, and auditors would be dragged in as internal control experts. But there again were general principles that were being applied. Certainly the AICPA had evolved its definition of what internal control was, but it was subject to a great deal of interpretation. It was again a principle. Internal control in the 90s was simply on the periphery. It was nice to have. It was nice to refer to. It just wasn't mainstream. But now enter Enron and WorldCom. And it was that double whammy that gave rise to the Sarbanes-Oxley Act. And as just an aside to preserve this for memory, it's interesting to note that what was happening around the time of the passage of the Act was Enron had happened about 5 or 6 months prior to that. And there had been a great deal of negotiation going on between the profession and the regulators and the like to come to a conclusion in terms of how best to address internal control. And there was a non-regulatory solution. There was basically a self-governance solution that was in the works. And then WorldCom blew. And within 5 days, I think SOX was passed. So it's interesting to note that you needed that double whammy to get things to where they are. So all of a sudden now, everyone had to not only think about internal control, but had to report on it on an annual basis. And this reporting oftentimes came with two heads. Both management and the auditor were required to report on internal control. It was really like the Tesla acceleration in ludicrous mode. We went from 0 to 60 in 2 seconds. The intent when regulators first put pen to paper was to be somewhat prescriptive in telling people what to do relative to internal control, rather than be principles focused. However, when trying to be prescriptive on something as untested and as squishy as internal control was difficult because it was also qualitative. There was a first attempt at drafting requirements relative to internal control in AS2, and that was the regulatory regime that people were focusing on for the first couple of years when reporting on internal control. But that was found to be too prescriptive and was considered to be too focused on day-to-day baseline operational controls. This evolved very quickly into AS5, which chose to focus on higher-level management review controls and began to, I would say, straddle the prescriptive principles line. This is the framework that we've all been living with since that point in time. Now, just like standards are written, they're always subject to interpretation. And this has certainly been subject to interpretation for the last 10 years. The PCAOB, again, remember, wrote its succession of standards for auditors. The SEC itself put out their own parallel standards for management. These were intended to be very similar in concept. But when you think about interpretation and implementation, any standard accelerates upon use. And since PCAOB inspections occur hundreds of times a year, guidance and interpretations of those standards from an auditor perspective evolve very rapidly. The SEC, of course, was focused to some degree on internal control, generally CorpFin and OCA when addressing things like material weaknesses and enforcement in certain cases, but it just wasn't subject to the same drumbeat of the inspections that the PCAOB interpretations were. So hence, we're at a point now where we're still trying to correlate regulatory expectations at a PCAOB level and an SEC level with what management expects and does and what the auditors expect and do. And we're always in this conflict between prescriptions and principles. So what does the future hold for auditor and internal controls? There certainly has been continued debate around internal control provisions of SOX. And if you recall, there's both a manager report on internal controls and an auditor's report. And market capitalization determined the intensity of the focus. And there were certainly, and has certainly been competition arguments for continuing to move the capitalization threshold upward. That is, not make small cap companies subject to either both the management and the auditor report or just the management report. But this has been really a fraying around the lower edges. The SOX regimen is here to stay. We need to live with it. If you look at the commentary levied by the PCAOB to auditors, and when you look at the SEC focus on back and forth on what constitutes a material weakness, the internal control is part of the landscape for the future. It is the area where there is a preponderance of inspection deficiencies, and it is difficult to believe that in the wake of this there would be less emphasis on internal controls. Yet given that existence is not questions, debate is still more granular about what internal control is and how do you reconcile what expectations of an auditor is and what expectations of management are. It is important that as we go forward, we reconcile these two, and the industry and the SEC and the PCAOB are all interested in making sure that we come to some sort of agreement or general framework relative to things. It is either squaring edges on principles or it is rounding the edges on prescriptions.
Thanks, Dan. I just have one quick question before we move on to the next topic, which is, I gather from what you said that internal control regulation is largely driven from crises, financial crises, particularly fraud and public company crises. Will we have to see large amounts of that again in another crisis before we have any substantial change in internal controls? Or if there's no crisis, can we kind of relax and assume the regulation will persist the way it is?
I guess my feeling is that the framework has been established, and so people do have something to fall back on relative to internal controls. And therefore, when people try to point to internal control failures, they can point to you failed X or Y in the context of what has been set forth as internal control framework under Coso and the like. So I think you have a very firm foundation to build on. What we need to work on right now is making sure that management and the regulators and auditors all understand what constitutes just the right amount. Not too much, not too little.
The Goldilocks amount of internal controls.
The Goldilocks effect, absolutely.
Okay, now for something completely different. Will Bible, who is a audit partner at Deloitte and Touche LLP and an ardent fan of audit innovation, is going to tell a little bit about the role of data and analytics, a subject near and dear to my own heart, on the auditor. Will?
Thanks, Tom. It is interesting. I mean, there's a historical context to kind of see data and analytics and just like internal controls. But unlike something that's responsive to crisis, I think what we're seeing right now with data analytics is responsive to market forces and to technological change. And so if we think about data analytics and the role of the auditor, it's not necessarily new. Data analytics have been used since the 1960s and 70s. They've been used to predict balances. They've been used to assess risk in audit engagements. Anytime that there's been the collection of digital information, people have tried to use analytics to improve the audit process. What has changed in the last really 5 or 6 years is just the explosion of information that's available. And so we've gone from a period of time where models that auditors were using to predict balances were relatively simple. Information that we were given from clients was somewhat easy to get your arms around, to a point where information is voluminous and it's ever changing. The velocity is extremely fast, and the models and the people are using are far more complex. And so we're at an interesting turning point where data has really challenged our ability or asked us to up our game in performing analytics to conduct the audit, because they are so powerful. And the way we see auditors using analytics today is extremely powerful, because the software that's been built around data analytics has improved at the same time. So we see auditors using data analytics to do descriptive types of analytics on populations to identify areas of risk. One of the more interesting developments recently is using visualization to visually identify things that are outliers for further investigation. And what we see with new software packages is the ability for auditors to visualize information, lots of information, very quickly. And from those visualizations to be able to identify outliers or things that look unusual and perform further investigation. And so that's a large focus for data analytics currently. We do still see audit procedures where we use complicated recalculations of estimates that management has come up with, and that we automate those using data analytics, as well as prepare our own predictions using complicated statistical models to predict what the outcome of a balance might be, and to compare that against an estimate that management had prepared. And so we're really entering into an age where data analytics are becoming pervasive to the audit process. And I think that as auditors become more proficient in using these tools, the data science behind them continues to advance as well. And so we're also starting to see experimentation with machine learning models, where very complicated data analytics are being built using complicated regression formulas, in some cases Bayesian approaches, to kind of try to sift through all the information that's coming at us as auditors. And so we're starting to see audit firms experiment with machine learning to even provide recommendations to auditors throughout the course of the audit lifecycle, and provide predictions or prescriptions as to what an auditor should do in response to risks that they encounter. And so that's at the very cutting edge of what's going on with data analytics. But it's certainly, I don't want to call it a golden era, because it is a challenge, and data analytics have been around for a long time, but we are starting to see them being used pervasively across every audit in multiple phases throughout the audit process.
So Will, I think it's no secret that various, among the big four at least, and other actually audit firms as well, are starting to think about the use of artificial intelligence in audits. Is that only the machine learning kinds of applications that you've described, or are there other kinds of activities as well?
Yeah, so as it relates to artificial intelligence, there's a lot of different kinds of applications. We see a lot of benefit in using artificial intelligence to extract information from documents. And so in the area of optical character recognition, we see natural language processing as another area, because auditors deal with lots of contractual information as well as produce lots of reports. And so pretty much in every area of research, with the exception of transcribing sounds into words or songs into lyrics, we've seen some form of that being applied in the audit process. It could be recognizing a picture and automatically tagging it for what it is that the picture is taken of, or really looking at contracts, extracting information, and preparing documentation around them.
So is it too early to speculate on what this means for the future role of the auditor? I mean, I don't think anybody's talking about not needing auditors anymore, but might there be substantial changes in skill requirements, and might there be a need for somewhat fewer auditors, maybe at the entry level? I know in some other areas of business, AI seems to affect more entry-level people than any other type of worker.
Yeah, so what we've seen already started to happen, and this has been happening for a while now because the digital transformation of our business process has been going on for quite some time, is that routine and rote tasks that are pretty low value add become automated, and professionals end up spending their time and attention on problem solving, on dealing with exceptions, on providing quality control over processes. Because even when we've built artificial intelligence solutions to extract information from large volumes of documents, machines don't always get things right, especially when you're dealing with an algorithm that is making a probabilistic assumption. And so when the machine gets things wrong, auditors need to be there watching and making sure that that's being caught and taken care of in the quality control process. And so at the same time, we see that certain slivers of people's jobs are being changed and perhaps automated, much the same way that when I started with the firm, the way we did scheduling was you received a voicemail in the morning that told you where to be for that week or the next couple of weeks. And now, of course, we have online tools and mobile applications that allow you to look at that information yourself. And so that changes the nature of what I was doing every morning and not calling my voicemail urgently to figure out where to go. But you replace that with a different task, which is actually analyzing the information and performing data analytics and performing risk assessments to focus on things that are of a higher value.
I'm sure you really miss those voicemails every week. We've had one question about, could you just describe a little bit what you mean by machine learning, and also if you could say a little bit about whether you see the preparation of people interested in becoming accountants and auditors, is that changing yet? I know the American Accounting Association faculty members are talking about it a lot, but I don't know if it's really happened much yet.
Yeah, yes, two very different questions. When I think about machine learning, I think of really a process more than a specific technique. And what it means is that a machine will provide a suggestion to a user. And we see this all the time in our kind of daily personal lives where we're listening to music. And because of our preference, we either say we like the music or we don't like the music. And the machine is watching for that indication of preference. And then the next suggestion that it makes is reflective of that updated information. And so when we think about machine learning in an audit or a business context, it's a similar kind of feedback loop where a machine provides an expectation or a suggestion as to either a step to take or maybe information that's relevant or something to investigate. And then the machine is set up to capture the actual action that's taken by the user, in this case an auditor. And the next time that it makes the suggestion, it's learned from that preference that's been expressed. And over many, many preferences, the machine starts to provide better and better expectations and recommendations. So that's the general framework for machine learning, and there's a number of different kinds of algorithms and approaches that one might use to implement that. But we're starting to see people experiment with how do you embed that into not only just business processes, but audit processes as well. When it comes to people entering the workforce, I speak with a lot of professors about this digital transformation, and I think that most of them have indicated that there's some level of data analytics program that's being embedded in the core accounting field, or is elective, or they see their students taking it. Going back to the comment on internal controls that Dan was making, when we move into a more heavily information technology supported environment, there are new internal control related risks that our auditors need to understand. So I really advocate an informational technology fluency. Do auditors understand what an application is, what a network is, what the infrastructure is? How do you provide security and control over the data that underlies the data analytics so that you test for those right elements as you go through your audit process? And then when you're preparing your data analytics, the data that you're using is reliable. So I think that those elements are critically important to auditors coming in. We don't need auditors that all need to know how to code in Python. We don't need armies of data scientists, but to have a fluency in the language of data analytics and information technology and the risks, I think, is really important.
And it's interesting, just one other observation relative to this, and Will's touched on it, is you think about data analytics as part of the curriculum, and you think about internal control as part of the curriculum. What's more interesting to folks? Generally data analytics. So if you look at what's happened over the last 5 or 6 years, there has been a greater emphasis in data analytics throughout academia, and there have been chairs endowed relative to that. Internal control tends to be the poor stepchild because it is boring very often, but it is very important. So I would always advocate that we have to move on both fronts as quickly as possible and make sure people are trained both places.
Well, Dan, I'm sure your next topic will not be at all boring, the world of non-GAAP measures and key performance indicators.
Thanks, Tom. And I don't know if I can make anything accounting-wise not boring, but we'll try. So when we think about things like non-GAAP measures and key performance indicators, we again look retrospectively about what's been important to investors and who ultimately makes this judgment. Is it the regulators or is it the market? Certainly back in 1934, there was simply a need for somewhat timely historical financial information to be prepared on a U.S. GAAP basis. It was dictated by the regulators, and it was something that they wanted the auditors always associated with. At the same time, from a market perspective, investors have always been interested in caring about many other things apart from GAAP earnings. And these have been communicated through time in a variety of different forums. It certainly could show up in a 10K or an MD&A, but they could show up in press releases. They could show up in analyst calls. And they were all indirectly part of the public reporting structure, but they weren't subject to the extent of regulation that existed everywhere. There really is a paucity of non-GAAP financial performance measures that are specifically required for folks to look at. And this is despite a whole history of discussion around what are good key performance indicators for people. The market, again, has dictated to some degree what is out there, but that evolves through time. And the interesting thing relative to these key performance indicators is there never has been direct auditor association with them. There's indirect association with them in that a lot of the security statutes say that if you're associated with a document, you've got to be familiar with everything that's in that document, and if something is not true, you have to raise your hand and say something's not true. But there's never been direct attestation or any sort of reporting on some of these KPIs. The other thing to think about on financial information is timeliness. Now, when you think about the SEC reporting regimen relative to this historical data, back in 2001, you still had 90 days to get your year-end earnings in, and you had 45 days to get your quarterly earnings in. And while that's gone back to 60 days and 35 days, it's still a long time, and that historical financial information, which is opined on by an auditor, is fairly stale. So the question becomes, are there ways that you can get information out on a real-time basis that is informative to the market that may or may not be attested to by an auditor? There's certainly a move toward real-time data overall. The question is it evolutionary or is it revolutionary? And I guess I'd probably argue it's been evolutionary. People have gotten access to data on a real-time basis over the last 10 or 15 years. But now the sophistication and accuracy of it does come into play. And you do want to start to think about, is it reliable or isn't it reliable? Now think back again to history. The 80s and 90s, maybe KPIs weren't out there, but what was happening out there? There's a whole bunch of non-GAAP information because US GAAP or ICFR GAAP or whatever was existing back then wasn't able to filter out unusual events. So if you had poolings versus purchases, or if you had restructurings, those are all things that impacted comparability. And people had to go to extremes to make financial statements comparable. And therefore that gave rise to this these non-GAAP measures. And these became so rampant and so persistent that regulators had to and continue to consistently promulgate and enforce rules to bring some order to the chaos of this non-GAAP reporting. It is a topic that regulators continue to have at the tip of their tongue. But what are some of the fundamentals of that non-GAAP story? Management always wants to tell a story. And the ability to use numbers to substantiate that story is really important to them. So nobody wants to preclude non-GAAP. And there is a recognition that there's a certain rigidity of the GAAP framework, but everything has to eventually reconcile back to that GAAP framework. There are adjusted financial statement numbers that can be reconciled, but then there are KPIs again. And again, KPIs have come to the fore. Some are financial, some are non-financial, some are industry-based. Think about it. Retail, same-store sales, sales per square foot. Customer satisfaction scores, this net promoter score that's out there. Investment performance. Number of users, clicks, subscribers. All these things are KPIs that do move markets. Some are certainly perceived to drive valuation, and some may not drive it. And I'm not sure how rich the academic literature is relative to what KPIs drive the market. But that's certainly something that is ripe for research and discussion because KPIs are very important. And if you want to get to a framework for what is important, academic research should be able to inform it. Now the question also is, should auditors be involved in this process? And is there really demand for direct auditor involvement? We certainly, in the profession, can say, we can do this attestation service on certain numbers. But at what point in time does the market really want that to happen? It's unclear. So for example, the green bond requirements. How important is auditor attestation to whether or not a company is meeting green bond requirements? I really think the market will be demanding that in long term. But in any event, as you look at this, auditors are directly or indirectly involved in non-GAAP measures and KPIs all the time. This topic will not go away. It's going to continue to evolve through time.
So, Dan, it's certainly my impression, and I think I've seen some research about this lately, that the difference between the market values of companies and their book values continues to increase as investors value things like, intellectual capital and brand value and reputational capital and so on. Do you see any possibility that any of these non-financial assets would ever be addressed by auditors, addressed by the SEC in any sort of systematic way, or is that just too hard to even fathom?
Well, it seems like the audit profession, when we deal with things that are soft and the like, we can always evaluate them for impairment. We oftentimes have trouble fair valuing them, and certainly there was ventures into fair valuation in the early 80s when inflation was running rampant, and that went by the wayside along the way. And certainly fair values creep into investments all the time in certain circumstances. But probably the framework that's necessary and the specialists that are necessary for full reporting on the fair value of certain assets is probably far in the future. The question becomes whether there are certain items in certain industries that require a specific focus, and whether certain elements relating to them or certain assumptions underlying their value might be able to be reported on. And that might be a way to attest to some things that might assist people understanding what fair values are.
But it sounds like for auditors to really get involved in that, there would have to be some sort of SEC regulation that would define, how that thing was measured and so on. And it doesn't sound like there's even a whole lot of discussion about that at this point.
I think if you had an attestation framework, whether it's for the SEC reg or not, auditors usually need to go by some sort of framework that they're auditing to. And while that might evolve through time, right now I think people like to anchor on certain things so that they can say these are the elements that were looked at. This is something that's promulgated by this regulatory body or this valuation body, and things are in accordance with those certain items.
And as one commenter notes in the Q&A section, so you have to be careful about companies attempting to mislead investors in this space because, as you say, everybody wants to tell a story, sometimes perfectly accurate and sometimes not so much so. We should probably move on to our next topic, which also is a bit of a contrast. So Will is going to take us into the magical world of blockchain and tell us what that has to do with the evolving role of the auditor.
So Dan got the challenge of not making something boring, and I get the magical world. That's pretty challenging. So I'll do my best here. Unlike these other topics that we've been going over, blockchain is something that's very, very new. And to soften that a little bit, blockchain as a technology has been around since the mid-2000s when it was introduced in the Bitcoin network. But in terms of it being part of business processes, it is still very much in the experimentation phase. And so we spend a lot of time with clients these days talking about blockchain, clients and regulators, and what does it potentially mean, what is it to begin with, and what are the implications of using blockchain technology. So with accountants, I usually like to start very simply that blockchain is something that we're all very familiar with. It's a ledger. It's rows and columns. It's a database. What makes blockchain unique is that unlike a ledger that we typically would keep behind the firewalls of a company in private, blockchain is where you have a peer-to-peer network where all the different nodes in that network, and maybe different people outside of the company, and usually have copies of the exact same set of information. And so that's a fundamental shift in the way we think about data and data privacy. Traditionally, data is something that's kept private and used for a competitive advantage. In a blockchain, the storage aspect of data has been decentralized, and so it's been shifted away from being private on a server under lock and key to being promulgated across an entire network. And there's some interesting characteristics that come out as a part of that, because in some ways it makes the information more resilient, meaning that if everyone's maintaining similar copies of the ledger, if one person changes their copy, then they fall out of sync with the rest of the group. And so the redundancy creates some properties of censorship resistance that blockchain has. Now, what's also critically important, though, is that no one wants to have all their information copied and spread about an entire network. And so blockchain also relies on encryption technology. And in particular, some of the more popular blockchains like Bitcoin and Ethereum and others, it's a public key cryptography scheme where every person has a public address that is a string of numbers, but in order to access the information at that address, there's a private encryption key that is used to decrypt those entries and make transactions. And so you have a situation where you've got data that's now been made public, but it's encrypted. And so in theory, no one can really anticipate or understand what the information is without being able to decrypt that information. But it still has the same characteristics of being censorship resistant because everyone's maintaining their own copy. Now, when you have a public ledger like this, one of the key things that is a challenge is who gets to make adjustments to the ledger. Someone has to be able to post an entry for it to have any kind of value. And so what blockchain solutions have come up with are consensus mechanisms. The most popular one, or the one that's most well-known right now, is the proof of work mechanism, which means that a computer has to solve an arbitrarily difficult formula in order to earn the right to post to the ledger. And for earning that right, they also earn economic compensation in the form of a cryptocurrency. And that essentially is used to keep the network or the ledger in sequential order so that you don't have entire chaos with people posting entries to the ledger. But once someone has earned the right to post to the ledger, all ledgers are then updated simultaneously or near simultaneously all the time. And so in this type of scenario where blockchain technology has been adopted widely, some really interesting things happen for accountants and for financial reporting. Primarily, there's no more reconciliation. And so if we're all using the same ledger and the same data then, and it's being kept in sync at all times or in near real time, then we don't have to reconcile our alternative ledgers to see what the differences are. And so if you think about that, that's a major underpinning of business process today, is that we all keep different ledgers in different databases, and at some periodic point in time, whether it's frequently or infrequently, different companies and actors get together and reconcile that information to make sure it's in sync, going back to the internal controls that Dan was talking about earlier. Blockchain kind of turns that on its head. It says by spreading the data out and getting everyone access to it, but keeping it encrypted, we can avoid the problem of reconciliation, and we can all be using the same data source. Now, the technology is nascent, and so while there are proofs of concept being undertaken in almost every industry, and it's not just in accounting and finance. There's things like medical records, digital identity, land titles, some jurisdictions even looking at taxes that are being used. No one has come to scale with a full blockchain solution other than the Bitcoin and Ethereum networks, which are public solutions. But there is a lot of progress being made in this area. I think that the biggest impact for accountants and auditors will be, one, figuring out which blockchain solutions are trustworthy, because while everything I just said may make sense in theory, the devil's in the details in terms of implementation. And so it's quite possible there could be blockchain solutions that don't have the characteristics that we're looking for to make up trustworthy and reliable audit evidence. And then two, thinking about what we can do with a standardized database of transactions, because it may mean that we can build automated audit routines on top of those transaction flows to perform more real-time auditing procedures, because we're able to access the information just like participants in the blockchain. So that, in a nutshell, is the magical world of blockchain. It is an area that is undergoing rapid innovation. There are real challenges to scale, not the least of which is the privacy concern, that if someone does break the encryption, All your transactions are laid bare for anyone to see. And there's also challenges with technical challenges. Blockchain by its very nature is less efficient than a standard database because you're replicating data over many nodes. And so if you were to try to pump the entire internet through blockchain technology, you'd essentially be copying far more data than would be useful. So it's important that the implementations of blockchain are places where it makes the most sense. So there's a lot going on in this area, but it's certainly something that, because it's about ledgers, which are near and dear to accountant and auditor's heart, is something the profession is paying attention to and should continue to.
So this falls under the category of potentially big change, but not something that auditors have to worry about in the short run. Is that fair to say? I mean, what if I know nobody knows, but if you had to venture a guess when blockchain would be deeply embedded into the financial systems of major corporations, is that more than a decade away, probably?
I don't think that far. There are a number of major corporations that are working with their counterparts to bring blockchain solutions into production right now. How much volume goes through those solutions versus traditional channels is a big TBD. And so, I think there will be audit teams that are encountering blockchains being implemented on their engagements, in the current coming audit cycle next year. Will those be at scale such that they're material to the financials of those companies? I'm not sure. So I think that that we'll start to deal with the issues and the information technology issues around auditing blockchain information and relying on blockchain information. When it becomes at scale, though, is another question. And so is that 2, 3, 4, 5 years? It probably will be application specific. Many have said that the blockchain technology has been searching its killer application. And so is that going to be in payments? Is it going to be in identity? Is it going to be in voting? Not really sure at the moment, but that'll drive when it becomes something that is part of everyday life for accountants and auditors.
I guess it's mostly now used for non-traditional assets, things like diamonds and so on, but if those are on an organization's balance sheet, then there would have to be some attention paid to their auditing, right?
Yeah, and we see people experimenting in supply chains, for example. That's a supply chain is a network of companies that all have a common goal, and so to share data across a network like that makes a lot of sense from an operational perspective. And so then if an auditor is interacting with, where's the inventory currently, you might end up going to a blockchain to try and figure it out. So there's it seems to be pervasively explored at the moment, and by the time we're doing another one of these webcasts, it might have a completely different answer, but that is to be seen.
Well, great. We come to our last topic, which is the auditor's report, and perhaps Dan can speculate about when auditors' reports will be delivered on blockchains through artificial intelligence, but probably I don't think that's his primary focus. Dan?
Yeah, I'm just watching the sun setting on the slide. So, I just, again, knowing, I think, who most of our audience is, I do want to bring back the auditor's report to agency theory. And the whole idea behind an auditor was monitoring what management was doing relative to the operations of a company. And as corporations became more complex, shareholders became farther and farther from that company, and they had management acting for them, and somebody had to monitor that management. So in a simple governance structure where there was no such thing as an audit committee way back when, you got to a point where the auditor was sort of the monitor relative to the operational results and making shareholders comfortable that indeed the reports reported by management were indeed what they were. So the report itself has been a fixture since 1934. In general, the auditor's report on a set of financial statements has been boilerplate language since that point in time. Now, back in late 80s, early 90s, the auditing profession decided that they would have 3 paragraphs instead of 2 paragraphs, but it was still boilerplate language. The trigger or the pay attention investor part of those reports was if an additional paragraph was added to those. And in general, those trigger paragraphs had variances from standard language. And it meant you better focus more closely on certain things. Yet even when you looked at those trigger paragraphs or trigger sentences, they were very short. And there was very little disclosure in them. You had to look back to the footnotes of the financial statements to understand more fully what an auditor was referring to. And usually they were focusing on a specific element of the financial statements. So what did those reports say? Well, they had an introductory paragraph that said, again, that management was responsible for financial statements and that it was the auditor's responsibility to audit those financial statements. Then it had a scope paragraph, and the scope paragraph simply said, here's the general nature of the audit, and it was conducted in accordance with generally accepted auditing standards that existed out there to provide reasonable assurance that the financial statements were free of material misstatement. Reasonable and material, two adjectives that you can take one way or another. But that was trying to emphasize that these weren't precise. They were precise to the extent of materiality, and that the financial statements were full of a number of estimates and the like that did not lend themselves to very specific point designations. And then at the end of the report, the third paragraph said the auditors were expressing a report on the financial statements taken as a whole. And if something had to be emphasized, there's a fourth paragraph. Now what happened through time is this whole governance structure within a corporation changed. And not only do you have a board of directors, but you had an audit committee. And over the last 20 years, the audit committee has become very active in acting for shareholders and acting as maybe a bridge between the auditor and the shareholders. So the audit committee was recipient of much more than just a 3-paragraph audit report, but they were recipients of a bunch of fairly prescribed information that described what the auditor did and what the auditor found and what the significant judgments that were made occurred during the course of the audit. And it was up to the audit committee to filter that and to act in the shareholders' interest relative to that information. So the question became in the long run, should the audit committee be the recipient of all this information to the exclusion of the investors? So there has been a history over the last 10 to 15 years in terms of whether or not some of the communications that have gone to the audit committee in the past should make their way to the general investing public. Should the investors understand more than what is in those standard 3 paragraphs? And this is where Europe beat us to the punch. The UK came out with some standards, auditing standards in the last couple of years, that talked about an auditor's report being something more than 3 paragraphs and include some explanations of critical things that were encountered in the course of the audit and the disclosure of some additional information. And this has evolved through time. And just recently, in October of this year, the PCAOB had a rule finalized relative to the standardized audit report for public companies. And while it isn't effective, the key provision is not until 2019, it incorporates this idea that an investor needs to hear about something other than these standard 3 paragraphs. They want to hear about these things called critical accounting matters, critical auditing matters. And critical auditing matters defined as any matter arising from the audit of the financial statements that was communicated or required to be communicated to the audit committee and that relates to accounts or disclosures that are material to the financial statements. There's that word material again. And that involved especially challenging, subjective, or complex auditor judgment. This was a challenge for the auditor to point these things out. It requires the auditor now to have some sort of prosaic skills. You're not going with boilerplate anymore. It meant that registrants now have to consider whether or not an auditor is disclosing new information in his or her report on the financial statements, and how you reconcile these things in this day and age. So there'll be interpretations coming out of this over the next year or so. We can look to the UK market to what happened relative to this, but this is a true evolution of the auditor's report. It is providing more information to the investor, providing that information that was previously just the purview of the audit committee, and is intended to create a more informed market.
So Dan, we have time for maybe one quick question. Do you think that the role of the auditor changed much with this enhancement of audit committees in terms of size and backgrounds and so on? I think that happened shortly before SARBOX, but was incorporated into it.
I think the role of the auditor has increased through time. What happened was a lot of items were put in terms of what the audit committee had to inquire of the auditor about. It required the audit committee to become more sophisticated, and therefore the role of the auditor increased, and the transparency of the auditor to the audit committee, and ultimately through this to the investing public, became more apparent. So
good thing as far as you're concerned to have that happen, both the audit committee and the new role of the auditor. I saw on the AAA website there is a new academic paper suggesting that investors haven't necessarily gotten more value as a result of these changes in audit committees, but I'm sure that debate will go on for a while.
Yeah, it's a very interesting situation, and there certainly has been a wealth of communication with the audit committees. The audit committees are very interactive with the auditor. And again, some of the information that was shared at the audit committee will make its way to the general public, which I would hope would have contained more information. And that's what the markets need, more information.
And it certainly increased the desirability of people with accounting degrees. It makes it much more likely they will end up on corporate boards in the long run. So,
I always like the full employment act there.
Yeah, exactly. We have pretty much run out of time. I want to thank Dan Sunderland and Will Bible for their very astute comments about how the role of the auditor has already changed and will continue to change, and I hope this goes down in the SEC museum archives as one of the most interesting fireside chats. I expect that it will, so thanks very much.
This concludes our presentation for today. This webinar will be available in archive in about an hour at the same link as the live webinar. So feel free to come back to review any of the content or invite colleagues that you feel may find it valuable or interesting. The slides will also be available for download within the archive. Thank you for joining us, and have a great day.